Before we get into the mathematical formulations, it's important to understand the nature of risk itself. So risk is always present in financial markets, but understanding and assessing it is considerably more challenging than simply knowing it exists. This difficulty comes from risk's abstract natures. You can't touch risk, see it directly, or measure it with a ruler. It's a probabilistic concept that requires statistical thinking. Risk is perceived as something hazardous, and it might be either expected or unexpected. This distinction is absolutely critical for risk management. Expected risk is something that can be priced into investments. Investors demand higher returns for taking on known risks. For example, everyone knows that small cap stocks are generally riskier than large cap ones, so investors expect higher returns from small cap investments. However, unexpected risk can barely be accounted for, which is why it can be devastating. In the 2008 financial crisis, for example, or the COVID-19 pandemic, or the dot-com crash, these are all examples of largely unexpected risks that caused massive losses because they weren't properly priced into the market. This is why risk management is both an art and a science. We can use something sophisticated like mathematical models to quantify known risks, but we must also maintain humility about our ability to predict truly unexpected events. Now let's establish formal definitions that will guide our mathematical approaches. Risk can be defined as any event or action that may adversely affect an organization's ability to achieve its objectives and execute its strategies. Or alternatively, the quantifiable likelihood of loss or less than expected returns. Notice this definition has two parts: the qualitative aspects, events that affect objectives, and the quantitative aspect, quantifiable likelihood of loss. This dual nature is why you need both judgment and mathematical models in risk management. All financial investments are made to gain profit, which we call return. A return is the gain made on an investment over a given period of time. Therefore, a return refers to the upside of risk. It's what we hope to achieve by taking on risk. The relationship between risk and return is fundamental to all finance theory. Investors are generally risk-averse, meaning they prefer certainty to uncertainty, all else being equal. Therefore, to entice investors to take on risk, we must offer them the prospect of high returns. This creates a fundamental risk-return trade-off that underlines all investment decision-making and forms the basis for the mathematical models that we will present today. Now let's examine how standard deviation functions as a measure of risk. Standard deviation measures the dispersion of data from its expected value. In the context of investments, it measures how much the actual returns deviate from the average expected return. Standard deviation serves as our measure of total risk, used to quantify the historical volatility associated with an investment relative to its rate of return. It provides a statistical measure of how spread out the returns are from the average return. The standard deviation indicates how much the current return is deviating from its expected historical normal returns. For example, if a stock has an average annual return of 10% with a standard deviation of 5%, this means that approximately 68% of the time, one standard deviation, the returns will fall between 5 and 15%. Here is a practical example. Consider a stock that has high standard deviation. This stock experiences high volatility and is therefore considered riskier. If stock A has returns that may vary between negative 10% and 30%, while stock B has returns that can change between plus 5 and plus 15%, stock A has a higher standard deviation and higher risk, even if both stocks have the same average return of 10%. Investors who are more risk-averse would prefer stock B, while those willing to accept higher risk for the possibility of higher returns would choose stock A. So this slide shows one of the most fundamental concepts in finance, the direct relationship between risk and return. The graph shows the risk-return trade-off, with standard deviation risk on the x-axis and return on the y-axis. The upward sloping line shows that risk and returns are directly proportional. As risk increases, the required rate of return increases proportionally. This relationship is intuitive and can be observed across all financial markets. Government bonds, which are considered very low risk, offer very low returns. Corporate bonds offer higher returns than government bonds because they carry more risk. Stocks typically offer higher expected returns than bonds because they're riskier. And within stocks, small cap or emerging market stocks offer higher expected returns than large cap domestic stocks because they carry higher risk. The key insight is that this isn't just a theoretical concept. It's a practical reality that investors face every day. When risk decreases, the required rate of return decreases accordingly. This is why during periods of market stability, interest rates and expected returns tend to be lower, while during periods of uncertainty, investors demand higher returns to compensate for increased risk. Understanding this relationship is very important for portfolio construction and investment strategy development.